glance at the market on a day like today, January 14th, 2026, it's easy to just see a bunch of red numbers and move on. But trust me, underneath that surface, there is always a story. And today's story, it's a really fascinating one. It's about a major clash between some really powerful forces. We're talking a policy bombshell out of Washington on one side and a corporate giant collapsing on Fifth Avenue on the other. So let's get into it and break down what really moved the needle today. Okay, so here's the final tally for the day. As you can see, the Dow and the S&P 500 were both down. But look at the Nasdaq. It got absolutely hammered, dropping a full 1.6%. That right there is our first big clue for the day. It tells you that the tech sector was feeling some serious pain, and that points us directly to where the market's biggest anxieties are right now. So that's the big question, right? What really happened? Was this just some random run-of-the-mill bad day, or are there much bigger gears turning behind the scenes? Well, it turns out the market was getting hit from two completely different directions. We had a major policy shock coming straight from the top in Washington, and at the same time, some really serious stress was bubbling up from the corporate world itself. Let's dig into both of those. All right, first, let's tackle that top-down pressure. The White House rolled out a brand new playbook today, and it's aimed squarely at the defense industry. And believe me, it is sending some major shockwaves through the market. This is all part of a much bigger strategy they've been talking about, something they're calling the peace through strength agenda. This quote right here, it just perfectly sums up the whole thing. For decades, the name of the game for so many big companies, especially these massive defense contractors, has been all about rewarding shareholders. You know, stock buybacks, dividends, that whole song and dance. Well, this new executive order just completely flips that script. It basically says, hey, we don't just care about your stock price anymore. We care about what you are actually building for this country. It's a fundamental shift. And this isn't just some vague threat. The executive order lays out some incredibly specific and very tough new rules. First off, no more stock buybacks and no more dividends until your production goals are met. Period. Next, executive pay, yeah, that's now tied directly to delivering on time. And finally, if you're late, you can bet there are going to be significant new penalties. This is a massive change, and it forces these companies to put actual output way ahead of shareholder payout. So what's the big idea here? What's the end game? Well, this is a core piece of that peace through strength agenda we mentioned. From the administration's point of view, the old system had just gotten way too slow, way too bureaucratic. It was prioritizing paperwork over actual production. This new policy is basically an aggressive attempt to shake up the entire defense industry from top to bottom and force it to innovate and, most importantly, deliver faster. Now, get this. While that political earthquake was shaking things up in Washington, a completely different kind of shockwave was hitting the market, this time from the bottom up. And it all started with one of the most iconic names in luxury retail. Yep, this is the headline that really caught everyone off guard today. Saks Fifth Avenue has filed for bankruptcy. I mean, this is a huge deal. We are talking about an absolute pillar of high-end retail. And what makes this even more stunning is that it comes just 1 year after they took on a mountain of debt to buy their biggest rival, Neiman Marcus. Just a total shocker. And the fallout from this is just massive. Saks owes a staggering $225 million. And not just to anyone, to some of the biggest names in luxury you can think of. We're talking brands like Chanel, Kering, and LVMH. So you see, this isn't just one company failing. It's sending a painful ripple of financial distress through that entire luxury goods ecosystem. So what does this actually tell us about the broader economy? That's the real question. When a store like Saks, a place that caters to the absolute wealthiest shoppers, goes under, it raises a major red flag. Is the high-end consumer finally starting to pull back on their spending? And if they are, well, what in the world does that mean for the rest of the retail sector and for consumer spending as a whole? It's a pretty worrying signal. The worries didn't just stop with retail, though. It's also that time again, the start of earnings season for the big banks. And this is always a crucial moment. It gives us a real health check on the economy. But the initial signs we're getting, well, they've been confusing to say the least. The season officially kicked off with JP Morgan, one of the biggest banks on the planet. And they kind of hit a sour note right out of the gate, reporting a surprise drop in their investment banking fees. You know, when a titan like JP Morgan shows even a small crack, it makes the entire market pretty nervous. And this, right here, just perfectly illustrates the anxious mood out there. Just take a look at Bank of America. On paper, they had a great report. I mean, they beat their earnings estimates and even projected some pretty strong growth for the rest of the year. So what happened to their stock? It fell over 3%. It just goes to show you that right now, the market's pessimism is so thick that even genuinely good news isn't enough to break through it. So you've got all this uncertainty, all this anxiety swirling around traditional stocks. The big question for investors becomes, where do you even put your money? Well, if you look at today's activity, it gives us a pretty clear answer. People are looking for alternatives, big time. So check this out. While the stock market was just bleeding red all day, money was absolutely pouring into Bitcoin ETFs. These are the funds that let people get exposure to Bitcoin without having to, buy the currency directly. In fact, today saw the single biggest inflow of cash they've seen in months. That suggests a growing number of investors are starting to see crypto as a potential shelter from this storm. This simple little chart really tells the entire story of the day, doesn't it? The S&P 500, which represents the broad stock market, was down. Meanwhile, Bitcoin was up over 2%. It was literally a tale of two completely different markets today, moving in completely opposite directions. And it wasn't just some digital gold rush either. The original safe haven assets were also shining bright. Silver prices absolutely surged, breaking above $90 an ounce to hit new all-time highs. This shows a really broad-based search for safety, with capital flowing into both new-age digital assets and old-school precious metals. Okay, so let's recap. We've seen a policy shock from Washington, we've seen signs of stress on both Main Street and Wall Street, and we've seen a flood of money rush into alternative assets. So how do we tie all of this together to really understand what's going on, to understand this new market reality? It really boils down to these three key forces all hitting at the exact same time. You've got this aggressive top-down pressure from the government, fundamentally changing the rules of the game for a major industry. At the exact same time, you have this bottom-up stress, with cracks starting to appear in consumer spending and the financial sector. And the result of that squeeze? A clear, decisive capital shift away from traditional stocks and into alternatives like crypto and silver. And all of this leaves us with a really big forward-looking question. What we saw today was a new, very assertive style of industrial policy coming out of Washington, and it was clashing head-on with the financial realities and anxieties of the corporate world. The turbulence this created might just be a one-day thing, or, and this is the important part, it could be the new normal that investors are going to have to learn to navigate for the foreseeable future. Definitely something to think about.
I am not a financial advisor. This is for educational and entertainment purposes. Do your own research.